welcome to a live market update with Buying South Florida. Today, I want to take a look at the new CPI report that was released yesterday, the inflation report. I'm also going to look at what the trend is in the mortgage rates, how that inflation report is going to affect or is affecting the mortgage industry, and how that inflation is going to affect going forward the real estate market, its values, etc. So, first and foremost, the report came out yesterday with a 0.8% month over month increase. Now, what that means is that it's an annualized rate of 9.6% of inflation. Essentially, what's happening with the market is, looking back at January to February, it's showing that there's an increase in the overall inflation of about 9.6. Now, that doesn't account for food and energy. If we account for food and energy, or if we exclude food and energy included, it's a little bit lower. Now, it's going to be very interesting to see how this report is going to change once the new report comes out in March, and it has the February data. Right, in February is where we saw, or now in early March is where we're seeing most of the increase in oil. So we'll take a look at the CPI report here, straight out of the Labor Department. We'll see that there was an increase of 0.8% in February. Right. Essentially, we all know that inflation's causing everything to increase. The cost of goods across the board is going up. I'm going to leave a link to this page here on the description, so you guys can look through the publication, etc. If you want to take a look at some of the the charts that they have and so forth. But we can see here on this chart, you can see the trend of month over month inflation looking back to last year in February. Right now, they also have a chart on here showing the specific sectors and how each sector has been affected or has increased with inflation. Now, again, the energy sector, I'm very interested to see what it looks like next month in the next report. Where the war in Ukraine, our heart goes out to Ukrainian people, but this is a sector that's going to increase significantly more than what this report shows, in my opinion. Right now, how is that affecting mortgage rates? So we can take a look at the 10-year Treasury again, and we can look back a year and kind of just see how that compares to the inflation. Right, we saw an inflation chart here, kind of a little bit of an up and down month over month, but you can see the 10-year Treasury kind of follows that inflation here. Now, what's happening now is we're seeing, because of the war in Ukraine, so much inflation, so much volatility in the market. We're seeing that a lot of institutional investors, a lot of private investing and so forth, they're moving their funds out of stocks and equities and going into a safer investment vehicle, which are bonds, for example. So the more money that goes into bond, the lower the yields, etc. It keeps the higher the yields, and mortgage rates tend to follow that as well. So one thing to also keep in mind, as of yesterday, the Federal Reserve did end their tapering program. So essentially, the Federal Reserve stopped buying bonds. When the pandemic started, this was one of their fail-safe responses to the pandemic. It essentially lowered or kept the mortgage interest rates at a historic low. But we have to keep in mind that the rates now are back to what the rates were before the pandemic. We kind of were a little bit spoiled over the past 2 years with interest rates in the 2%, 3%. We had to keep in mind, in the grand scheme of things, those interest rates were artificially kept low by the federal government. So if we look back at early 2020, you can see that the bond market is essentially back to pre-COVID levels. So if we exclude this 2-year COVID period, the rates are about the same, right? Sure, they've been on the rise. It was expected. The Federal Reserve has been announcing that we're going to end their tapering program on March 10th, and that did happen. Now, the Federal Reserve is meeting again on March 15th and on March 16th. This is expected, or this is where they are expected to increase the interest rates. Now, keep in mind the interest rates that the Federal Reserve is going to increase are the short-term variable interest rates. They're not the mortgage interest rates. So, the short-term variable interest rates are expected to be increased 0.25%. The idea is that increasing these interest rates is going to help inflation remain low or come back down. I personally don't think that increasing the interest rate 0.25%, so 0.25, is going to have any effect on the actual inflation. Inflation is 8-9%, and right now increasing the short-term variable interest rates to 0.25, it's not going to really have an impact on inflation. Now, if the Federal Reserve wanted to outright to stop inflation, they would have to force a recession on us. They would have to increase these short-term variable interest rates to 6-7%. It'll cause the country to go into an immediate recession, but it would essentially, at least in theory, stop inflation from getting out of control. Nevertheless, whether you agree with that or not, the Federal Reserve is expected to increase these interest rates 0.25%. So what will happen to inflation at that point? No one really knows. My opinion is that nothing is going to really happen to inflation. So, which then kind of brings us to our next point, which is how is inflation affecting the real estate market? As everything goes up, we'll see that the landlords, the property owners, will pass on the expenses or the increased expenses down to the tenants. So as property insurance increases, property taxes, maintenance of these investment properties, the landlords will just simply pass on those costs to the tenants. So it goes to show you the importance of home ownership. In a environment that's increasing in inflation, if you buy a property over renting, right? Let's say you're renting a two bedroom, 2 bath. If you buy that same property today, that 2 bedroom, 2 bath cost or the mortgage is locked in for the next 30 years, which is something that I've explained on my other videos. Is when you buy a property today, you're locking in today's cost of that property going forward. So as inflation continues to increase over time, you've already locked in the cost of that property, so it becomes significantly easier for you to pay as time goes on. As opposed to renting, where the landlords will just simply pass on the increase to the tenants, and you'll never be, as a tenant, you'll never be able to pay off rent. Even if you retire, there is no paid in full that you get at the end. There's no satisfactory mortgage at the end of your work career. So it goes to show you that one of the best, if not the best, hedge against inflation is to own your primary residence over renting. Sure, there are some instances where it may make sense for some of you to rent over owning, but overwhelmingly, on average, the tenant that can purchase their primary residence and is able to purchase their primary residence should purchase it, right? Not financial advice. Obviously, every case is different. However, the importance of home ownership as a hedge against inflation, as peace of mind in going forward with landlord tenants, etc. It just makes sense for somebody to start their investment, their retirement plans, etc., with owning their primary residence. So some of the pushback or some of the chatter that I hear from my clients is that the market's going to crash and so forth. And honestly, no one really knows what the market will do. But the market is driven by supply and demand. And I can say that the supply and demand in South Florida is very different than in many other parts of the United States. So I'm quickly going to show you here some statistics from the National Association of Realtors, and this is a snapshot of essentially all of the homes that are pending for sale in the U.S. As of today's date, this report was released. It is through January, so we're looking back about a month and a half or so worth of data. Now here, you can see that anything over an index of 100% means that there is an increased demand or an increase in pending home sales. You can see the South, we have we're leading the way essentially in terms of pending home sales at 134%. The Northeast, there's a decrease, there's a lower pending sales in the market, so that's not a good sign for them. And also in the West, they're on a decline. So it shows you that supply and demand, essentially demand down here in South Florida is still very strong, or at least in the South region here. Now, I'm going to show you some market data for the South Florida market. Now, most of the data and analysis and thoughts that I put out is, for the Tri-County area in South Florida. This is where, I've been in the real estate market since 2006. I don't pretend to be an expert in any other market outside of, the one that I've been doing, working in for the last 16 years or so. But down here, I can say that looking back month over month or year over year, the data the closed sales last year, 968 versus this year in January, 1,008, it's an increase of 4%. So something to keep in mind here is that the inventory from January 2021 versus the inventory January of this year has gone down. So inventory is down, but sales are up. So what that means is that it's still a strong seller's market. And when we look at the same data for condos, we can see that there's an increase in closed sales, right? So there's a lot of sales going on, but the supply in inventory is down 74%, right? So that's huge. So, and the same thing goes for Broward, right? There's an increase or a decrease in inventory across the board in single family residence. It's 45% decrease. In condos in Broward, it's a 70% decrease in inventory. And then there's also, when we look at Palm Beach, there's also a decrease in inventory in single family residence of 52% and a decrease in condos inventory of 77%. So what does that mean for the market? It's still a seller's market, essentially. You have to, every situation is different for the buyers. It's important to know where you are in terms of your investment goals and so forth. You have to be able to determine whether it makes sense for you to buy your primary residence, stop renting, stop paying somebody else's investment off, and just buy your primary residence at the very least over continuing to rent. So you can see over time, rent is just going to continue to go up. And hopefully inflation begins to slow down a little bit. I personally don't foresee that inflation is going to slow. I think it's going to continue to increase, and therefore market rental costs are going to continue to go up. But if you buy your property, your primary residence, you lock in today's cost for that property. And over time, we can look back at the real estate data, especially the data of median or average sales price and so forth, market values. We can see an upward trend over the past 30, 40 years. It's always been on the upward trend. So to close here, I mean, we still know that inflation is going to continue to go up, which is causing the rental market to continue to go up. And we can also see that inventory is still low. It's decreasing, which means it's still a seller's market. So if you're looking for short-term investment to flip, I don't think it's the right time. However, there are some really good investment properties out there still that you're able to buy right at or below current market values. So there's some strategies there to still take advantage of. Nevertheless, home ownership has never been more important than it is today. And I hope this data was useful. I hope my market update helped a little bit. If you are on the fence about locking in your interest rate, talk to your mortgage banker or your mortgage lender. It may be a good time to lock in your rate. I don't foresee the rates going down any lower. I think they're going to continue to steadily go up, and that's, it's up to you whether to determine if it's a good time to lock in your rates or not. But rather to lock in at a lower interest rate than to risk having to pay more interest over time. So with that being said, guys, I hope this was useful. Please hit the like button if you found this market update productive, and subscribe if you haven't. Otherwise, until next time, be safe.